Dean of the School of Business at our great NDSU, North Dakota State University. Dr. Scott, phenomenal job today here at the Midwest Economic Outlook Summit. Appreciate all of the insight you gave. For people that couldn't be here, what do you think is the most important thing you talked about today that they should know?
That we're in a period of high inflation. That was a theme throughout. And I think my unique spin on it was that the inflation is self-induced. It's induced by a lot of federal spending. It's induced by extremely easy monetary policy. And you throw those two things together, and we have some of the highest inflation anywhere in the world here in the United States. And what are we going to do about it is the question. And that question is a messy policy question that could lead to some uncertain economic times.
So if you were king for a day, what would you do? I mean, we've had 80% of the money supply done in the last 2 years. How do you unwind this?
So one thing that I think should be done is looking more at actual market rates of interest and less at these forecasts that the Fed is using. The Fed wants to go slow and be very careful. The market is ahead of them saying, please, can you start tackling inflation? So half point interest rate hikes each meeting instead of these quarter point hikes. And yeah, just really getting serious about inflation, because it's going to take a certain amount of moral courage to get out in front of it.
So if they did half a point at each of the next 6 or 7 meetings, what's that going to do?
We would be to 2% sooner, and then we would be able to evaluate instead of this extremely gradual approach that's going to take all year. So I think that the inflation numbers are set to get worse, and the economy is still running hot enough that you could take a little bit of risk on hiking rates and not necessarily cool off the economy severely.
One of the things that jumped out to me that you talked about, we're going to get to the housing piece in a moment, but you also said one of the lead indicators how'd you say it? One of the leaders in all prior recessions is the Federal Reserve.
Mm-hmm.
Like, they're the problem.
Okay. Yeah, and in fact, previous Fed Reserve Chairman Ben Bernanke admitted this, saying we in fact caused the Great Depression. And there's been all of these questions. What caused the Great Depression? Was it the stock market crash? Was it some tariffs? And the Fed has owned that, so they know. And I think Neil conveyed this too, that we're worried that we might not do the right thing right now. And so they're running these dual risks. One is to keep money extremely easy, which is the side they seem to be biased towards, and we all feel the pain through inflation. The other is they overshoot and they mess up the economy by raising rates too fast. And it's what an ugly job in some respects, because they're trying to thread a needle between two really awful scenarios.
Yeah, he said today, hey, we're really proud of sort of what Congress has done as far as flooding the market with cash. And you push back on that. Why?
A little bit, so I think that it was understandable in the pandemic to say we don't know how bad things are going to be, and we need to put some stimulus into the economy. I don't think the stimulus was very well targeted and thought out. It was just, here's money, go and do what you want with it. So it was poorly used fiscal policy. And by going so big, there's less appetite for doing anything now. So let's say that as the Fed raises rates, we do cause a downturn. I'm not sure America is dying for a lot of additional fiscal stimulus. And then come back to the end of the year and we're going to have a divided Congress again. And there will be no desire to do anything. And that's healthy. Gridlock is healthy unless you need Congress to do something.
You brought up the word recession several times. You talked, I think, about 3 leading indicators. One of them sounds like it's already happened with oil. So what are those indicators again for our audience, and where are they at?
Sure. So new home sales, which are down 8% year over year. If you get to new home sales dropping by about 20%, that often correlates with recessions. Oil, as I mentioned, if oil prices double in a year over year period, that's the strike price for a recession. And the reason there is pretty obvious. When oil prices have skyrocketed that quickly, consumers are really having to adjust their budgets, and they're taking it on the chin. If oil was to go up double over 10 years, you can adjust and find a more fuel efficient car. Not so easy in 1 year. The Treasury yield, which is borderline inverted right now, is another key indicator. Interesting one is heavy trucks. Are people buying heavy vehicles? It's an indication of transportation and trade. And then I had one more that the VIX, just the volatility index on the stock market, which is quite high again right now, is an indicator that people are feeling extremely nervous. And nervousness can by itself cause people to stop spending.
Let's talk about that. Housing, you said that right now the indicators show that it's actually the worst time ever to buy a house, better to be renting. Yep. And then one gentleman stood up earlier today and talked about all the, like BlackRock and different funds that are buying up all these housing. So just talk to us about the housing market and what you see there.
So 1 in 3 homes is bought by investors right now. So there's California money coming into housing markets, and there's just a lot of cheap money again that's allowing people to buy real estate and other assets. The overall market is running extremely hot. More than 50% of all sales are above asking price. So you might list your house at 500K, Chris, and sell it for 600. This is not normal, but it's just an indication of people are hungry for housing, and they have a lot of spare money. I've got a friend out in Idaho. He was trying to do all the right things, had 20% down for a fairly expensive home in the 500K range, and got bid out by a Californian who was coming in with cash. And this is happening again and again, where there's a scarcity of houses, and then there's just money everywhere right now. And money everywhere is not something that lasts. And that was my bottom line message: is free money usually is something that is too good to be true.
Great point. But then you also mentioned the scarcity piece, right? So there's a real lack of demand in housing. So wouldn't it be fine then to buy now? Not demand, I should say supply. Apologies. There's a real lack of supply in housing.
Yeah. So the supply is extremely scarce. I think that the issue is that it's not as bad as, say, 2008 with a lot of subprime borrowing. It's like 4% as opposed to 15% during 2008. But there are people who have become extremely leveraged again by taking out home equity lines and other uses of their house to inflate their own balance sheet value. So you're seeing a comeback in activity. This past year, for the first time ever, people made more on their house appreciating than they did on income from their jobs. It's the first time in U.S. history, and this kind of just anomalous, really strong market behavior isn't going to last, and it's demand driven, and that's the thing that you could have housing prices continue to go up and up and up, but you're going to probably remain in an economy with inflation going up and up and up on everything, and that's not going to last.
With so much cash in the system, when do you see this bubble bursting in the real estate housing market?
It's hard, you don't know when exactly. The theory would be that, so two scenarios could play out. One, the Fed doesn't raise interest rates aggressively enough, and we just keep running at extremely hot inflation. But that hot inflation means everyone's worn out on their jobs. They're not keeping above on basic needs, and then they sell these expensive houses because the houses have gone up. So that could trigger it. The other possible trigger is the Fed gets policy wrong, and we slip into a recession because mortgage rates have hiked like crazy and nobody's wanting to buy. So Neil was talking about this morning, mortgage rates have climbed quite rapidly, and it has led to a decline in interest in buying and a real big decline in refinancing right now. So it could do some of the self-correcting just because we think the Fed is going to raise rates.
So you mentioned 8% now as far as new homes. You said 20 is the key kind of indicator. Do you see us getting to 20? And if so, how fast?
I don't know. Yeah, I don't know. I think that as we hike and as we see these uncertainties with mortgage rates where they're continuing to go up, it's quite possible that we get there sooner rather than later. It's multifaceted in terms of the number of things that could play into that, but there are signs that there's just this financial market uncertainty right now, and some of the economic data is indicating some softening. With the war as well right now, it could be sooner rather than later.
Let's talk about inflation. Where do you see this going? I mean, when does it start to taper off, and how high does it go?
It's going to go higher before it declines, and that's now thanks to these energy price changes that we're seeing. I think that so we're in 2022. I think 2023 is going to be a period of inflation well above 5% still, and it may drag into 2024. It's just the Fed is not doing the things, they're not engaging in the policies to take down inflation rapidly, and because they're being extremely cautious about not wanting to kill the economy. And in so doing, it'll take a long time to unwind from, the 8% inflation we're seeing now. It will come down, but it's going to be much higher than, the 2% goal.
What do you see happening with the stock market?
The stock market right now has adjusted and reacted some to Russia. I think that that's like a huge dark cloud over the stock market right now. It has grown increasingly volatile because of the Fed and because of uncertainty about that interest rate curve and what the Fed might do. Tech stocks have been getting hammered. Some of the PayPals and the Zooms, the pandemic plays have been getting hit especially hard. And the stock market if we experience high inflation, the stock market actually will do all right typically, because people are saying, I'll just put it in the stock market. Companies are going to enjoy higher profitability. If they become too jittery about interest rates, we could be in a period like the 1970s where the stock market just kind of yo-yoed around and didn't do much. And those are the two scenarios. Either it keeps climbing because money is cheap, or we get this extreme, yo-yoing.
As an economist, last question. You heard Neil Kashkari, president of the Minneapolis Federal Reserve, say he thinks 95% of crypto is hype, noise. What's your take on crypto?
I just don't understand it very well. So I get what he's saying. I think that its current value as like a use or a medium of exchange it's not, because it's moving all over the place. So it hasn't become a stable currency in the way that some people are saying it is. I do have some investments in it because I think that you'd be foolish not to, just in case it really is like the real thing. But he said 95%. He's skeptical, and then 5% maybe. I'm like more 80-20 or something like that. I don't understand it, but there certainly seem to be a lot of smart people who think it's really important.
Anything else you want to add that I haven't asked?
Yep. Thank you.
Very much.